One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallet addresses, VIP access, or signals, it's a scam. I sell nothing, ever. Now type ratio in the comments if you're locked in, because gold just opened around $5,400 while silver is around $95, and the internet is screaming one sentence like it's a law of physics. $300 silver is mathematically locked. Stop. This matters, because that sentence is half true in a way that can make you money, and half false in a way that can wreck you. Quick transparency. I tried to pull your exact Yahoo Finance article link, and it's blocked with a 429 too many requests error on my side, so I can't quote that page directly right now. I can confirm the same market snapshot and catalyst framing from other major outlets today. Gold around $5,400 and silver around $95 as markets react to escalating Middle East conflict, oil surging, and investors moving into safe havens. Now listen, gold doesn't open around $5,400 because some influencer said bullish. Gold opens around $5,400 when the world is repricing risk, when investors stop asking what's the return and start asking what survives. And you can see how serious this regime shift attempt is by the way investors are behaving. The Financial Times says big investors are turning to gold and the dollar, not bonds, because inflation fears tied to energy shock risk make bonds less reliable protection right now. That's not normal. The playbook is changing. Now your title hits the nerve. Gold $5,400, but silver only $95. That word only is the trap. Because only makes your brain think silver is cheap. Silver at $95 isn't cheap. It's already a high volatility, high stress regime. It just looks small next to a historic gold print. And whenever silver looks small, the crowd reaches for the oldest relative value weapon in precious metals, the gold to silver ratio. Here's the math everyone keeps quoting. No hype, just arithmetic. Gold price, gold to silver ratio. If gold is $5,400 and silver is $95, the ratio is 5,400, 95, 56.8. Call it 57.1, meaning 1 ounce of gold is worth about 57 ounces of silver right now. Now comes the viral leap. If the ratio collapses, silver explodes. Therefore, $300 is locked. But what they're really saying, quietly, is this. To get $300 silver while gold stays at $5,400, the ratio must compress to $5,400, $300 per 18. So the $300 is locked claim is secretly a second claim. The ratio will collapse from 57 down to 18. That's the real bet, not the price, the regime. And regimes are not guaranteed. Regimes are earned through behavior. Stop. Burn this into your brain. A ratio is not a prophecy. A ratio is a thermometer. It doesn't tell you where the market must go. It tells you what the market is preferring right now, gold versus silver, and whether that preference is shifting. So here's the honest version of your title. At gold, around $5,400, triple-digit silver is mathematically plausible with modest ratio compression. But $300 silver is not confirmed unless we enter an extreme silver-led regime where the ratio compresses toward us 18. That's not a math certainty. That's a behavioral shift. Now I'm going to map the behavior shift required, and I'm going to do it the way you can actually use without worshiping targets. There are only 3 forces that compress the gold to silver ratio aggressively. 1, silver becomes monetary again in the public mind. 2, silver becomes tight in delivery terms. Physical stress the paper market can't ignore. 3, the macro stress persists long enough that silver flips from following gold to leading gold. Let's hit these fast. First, silver becomes monetary again. Gold is institutional, central banks, big allocators, default crisis hedge. Silver is the public's metal. It feels accessible. It feels like cheap gold. It attracts the crowd when fear spreads beyond institutions. When the crowd shifts from watching to acting, silver can outperform gold simply because the market is thinner and more emotional. That's ratio compression. Second, silver becomes tight in delivery terms. This is the paper versus physical fault line. When everything is calm, paper leads and physical follows. When the system is stressed, physical starts leading and paper has to chase. How do you tell which world you're in? Simple. When paper price gets slammed, does physical soften instantly? Or does physical stay stubborn, availability tight, buyers refusing to wait, the whole market whispering, can you deliver? That stubbornness is the seed of every real squeeze narrative. Not memes, not vibes, delivery trust. Third, macro stress persists. Gold can spike on headlines. Silver needs persistence to truly lead. Because silver isn't just monetary psychology, it's also tied to industrial and inflation expectations. And today's reporting is already describing exactly the kind of environment where fear can become inflation and logistics fear. Middle East escalation, oil jumping, risk-off inequities, and safe haven flows into gold and silver. Barron's reported gold futures around 5,399 and silver futures higher as investors sought safe havens amid the conflict. So the first wave is here. Gold is trust hedge. The question is whether we get the second wave, silver as friction hedge. Now stop. Here's the open loop that decides whether the $300 crowd becomes legends or becomes exit liquidity. Does this crisis stay hot long enough for silver to shift from sympathy bid to lead metal? Because if it does, the ratio starts compressing steadily. If it doesn't, gold holds and silver chops. And most people lose money not because they were wrong about direction, but because they were wrong about regime timing. Now, I'm going to make this concrete because your audience needs a map, not a motivational speech. Here's the ratio, menu at gold, $5 to $400. Ratio 57, silver, 95, today's neighborhood. Ratio 50, silver, $108. Ratio 40, silver, 135.5. Ratio 30, silver, 180. Ratio 25, silver, 216. Ratio 20, silver, $270. Ratio 18, silver, $300. So yes, triple digits don't require a miracle, but $300 requires an extreme compression regime. And that regime reveals itself before the headline number prints. How? By relative performance. This is the simplest daily ritual in metals. If gold is up 3% and silver is up 2%, silver is underperforming. Ratio isn't compressing. If gold is up 3% and silver is up 6%, silver is leading. Ratio is compressing. If markets wobble and gold holds while silver collapses, ratio widens. Gold only fear. If markets wobble and silver holds up surprisingly well, ratio compresses. Silver strength regime. That's how you stop being hypnotized by targets and start reading the tape. Now, why is this $300 locked content so viral right now? Because the environment is perfect for it. Gold is printing historic levels, investors are openly questioning the traditional safety of bonds due to inflation fears, and the world is staring at energy shock risk. When gold already moved, the crowd hunts the catch-up trade. Silver becomes the catch-up trade because it feels behind, and because it's thinner, it can move faster. So the narrative writes itself. Gold is too expensive, silver is only $95, the ratio says silver must catch up. That story is powerful. It's also dangerous because silver punishes certainty. Silver is famous for one thing, brutal volatility. Silver can rip, then dump, then rip again, while the long-term trend remains intact. So the real danger in the phrase mathematically locked is that it turns conditional logic into certainty. And certainty is what silver eats alive. Now, here's the resistance case, because credibility matters. There are crisis phases where gold outperforms silver. Why? Because silver is also industrial and can get hit on growth fears. Because silver is more vulnerable to leverage flushes and forced selling. Because in extreme volatility, everything can get sold for liquidity, even hedges for a moment. And mainstream coverage itself signals how jumpy and uncertain this environment is. Equities down, oil up sharply, gold and silver surging as safe havens. So no, silver is not guaranteed to catch up immediately just because gold is high. The ratio can stay elevated longer than anyone expects. But here's what makes today different, and why the ratio narrative isn't totally crazy. The market is not treating this as a contained headline. It's treating it like an inflation risk regime. That's why investors are choosing gold over bonds, according to the FT. If that persists, silver has a better chance of flipping into leadership. Not guaranteed, but structurally plausible. Now, here's your 48-hour watch list. Binary, addictive, and designed for retention. 1. Gold hold test. If gold holds near these elevated levels across the next sessions, fear is persistent. Not just a headline spike. If gold snaps back hard, it was a fast risk premium repricing, not a sustained regime. 2. Silver leadership test. If silver starts outperforming gold on up days and refuses to underperform on down days, you're entering a silver-led phase. If silver fades while gold holds, it's gold-only fear. Ratio compression won't happen the way $300 narratives require. 3. Energy and inflation stress stays active. If oil stays bid and inflation fears remain elevated, hard assets can stay supported longer, exactly the gold over bonds dynamic the FT describes. If energy risk cools fast, silver's inflation tailwind weakens. 4. The slam test. When silver gets hit, does it snap back fast? Fast rebounds mean buyers are waiting. Tight market behavior. Slow bleeding means the bid is fragile. Now, final open loop. If the world is repricing risk hard enough to put gold around $5,000 to $400, confirmed across multiple major outlets, then silver's next move is not decided by your target. It's decided by whether silver begins to lead gold. Because if silver begins to lead gold, triple digits stop being a meme. And if silver does not lead gold, $300 talk stays content. This isn't financial advice. This is financial warfare education. 3 takeaways, and we're out. Gold around $5,000 to $400 is being driven by a safe haven rush amid Middle East escalation and energy inflation shock fears. $300 silver mathematically implies a gold to silver ratio around 18 at gold, $5,000 to $400, meaning you need an extreme silver-led regime, not just a high gold print. The only way to know if that regime is starting is to watch relative behavior, silver leadership, ratio direction, and how silver reacts on dips. Drop ratio. If you want me to map the next sessions as this regime either confirms or fades.